Is Snowflake finally done melting? Snowflake will definitely need to keep building and acquiring some ancillary services. And we think that Snowflake knew this all along. And that's why they had such a massive IPO back in 2020. Hey, everybody. Welcome back to Chipstock Investor. This week, of course, is Nvidia's annual March GPU Technology Conference, or GTC. There's going to be a lot of new product announcements at what is being billed at as the AI Woodstock. Welcome to all of our new viewers. And as longtime viewers can assure you, GTC won't disappoint. Regardless if you're looking for a hype bubble to try and poke a hole in it or a reason to keep pumping your own beliefs. Either way, enjoy the week with NVIDIA's GTC.
So there was, of course, in this weekend heading into GTC, this little news tidbit broken by Calculist that NVIDIA might be about to acquire another AI algorithm startup for as much as $1 billion. It's the Israeli startup Run AI, which has developed this layer of software that helps coordinate the flow of data in AI training. Probably remember NVIDIA has made a couple of acquisitions like this, Omni ML about a year ago, which helps miniaturize AI model training. So folks, the trend here is looking pretty clear. This generative AI revolution isn't simply about chips or even just simply accelerated compute hardware. This is about full stack, spanning chips, hardware systems, and the software running atop of those accelerated compute systems to help make generative AI useful. So to kick off the week, Casey and I thought we would actually tackle the topic of cloud software, which continues to get ditched and forgotten by a lot of investors as suddenly everyone wants to be a hardware investor, a chip stock investor. That's fine. That's why we're here. That's why we started the channel.
Yeah, I think, Nick, you've said for years that software is merely a simple service. There's no inherent technological moat in software technology. Moats are built over time through many years as a company expands and diversifies its offerings. We'll help illustrate this with our hierarchy of the economy chart that we created last year. You can see where the pre-digital economy businesses grew their moats with the breadth and depth of their products and services. And ironically, hardware alone isn't a superb business model either. One day investors now flocking to semiconductors and devices will no doubt realize this as well. While a hardware company can build up its defenses with patents and IP protection, it's a highly cyclical endeavor. 1 year's booming sales can be followed by a deep slump that erases progress. It's incredibly hard to land hardware win after win and keep the momentum going from past successes, while also cannibalizing those past product successes with the newest and shiniest contraption. So this leads us to our philosophy here at Chipstock Investor.
Yes. And that is the best computing and electronics technology investments consist of some sort of vertical integration. And usually that means hardware and software, some sort of cohesive combination of the two, hardware and software, or if not software, some other form of recurring service built atop that hardware platform.
And in the coming couple of weeks, in the wake of NVIDIA's GTC, we'll be covering 5 stocks other than NVIDIA that you need to know about. Those companies are Snowflake, Oracle, Broadcom, PureStorage, and DigitalOcean, each of which is building a mixture of hardware and software in their business model. However, we want to do a deeper dive on each of these companies rather than a more superficial overview of what we're buying right now. And so today we're going to be talking about Snowflake, the old cloud software model that has lost some of its luster since the peak hype cycle in 2021. But before we get into Snowflake, make sure you're subscribed to the channel and have your notifications turned on so you can hear about all 5 of these stocks. Okay, let's jump in. Is Snowflake finally done melting? I like your pun, Nick.
Probably an overused cliche at this point, but
No doubt.
I put it in the notes anyways. We're all going to have to deal with it now. Okay. So, Casey, we're going to start here because out of the 5 companies here, Snowflake is not making a ton of investment into hardware. A lot of investors that have been in on this from the very beginning probably know they do make pretty heavy use of cloud infrastructure providers like Amazon AWS. So companies like that, like AWS, have competing services. So as any software business and software centric business, Snowflake, again, just to reiterate that, has no inherent technological moat. This is a highly competitive marketplace. And so you can see from this very simple historical stock chart, this was very much a darling in 2020 when it had its IPO, got sold off pretty hard early 2021, made a raging comeback through the end of 2021. And then the last 2+ years, not so great. Along the way, we've followed this stock. We've written about it at least a couple of times each year since the IPO. And we've long maintained that some patience and just simply feeling okay with just watching from the sidelines would be a good practice. Just be content with letting the stock do what it's going to do and wait for a better valuation or entry point or whatever you want to call it to come. And so for the last couple of years, after a very clearly absurd IPO valuation got burned off, we've warmed up to the idea that Snowflake maybe would be a good dollar cost average stock, but ample prudence would still be necessary because never at any point in the last couple of years after that post IPO burn off happened has the stock been cheap. And even at this point, I think we're merely saying the valuation is starting to look reasonable, not cheap, just reasonable. We think that the time has come for us anyways to nibble.
Let's go over a little history here of not only our analysis, but also some changes that have been made within Snowflake as well in the last year. There has been a ton of noise in the media in regards to Snowflake since its IPO in 2020, which was just in time for the cloud software boom during the pandemic. Snowflake really cashed in, securing itself a huge sum of cash for many years to come. But a lot of investors got lured in there at the beginning. And we're just going to discuss our process a little bit here from 2020. We're radically moderate when it comes to investing. And we know that isn't everyone, but it has served us well, especially with a company like Snowflake.
Yeah, that's right. The analysis got hacked up into short form articles, and we'll have links to all of those below. Besides just the simple valuation being pretty wild in 2020 and 2021, we were actually content with our ownership stakes in Salesforce and Berkshire Hathaway, both of which actually participated in that IPO. And then Salesforce in particular steadily sold off its position in Snowflake through 2021 for a pretty sizable profit. So we actually were sort of in a roundabout way Snowflake investors, but didn't want to own the stock directly because we saw not just too many chickens being counted before they hatched, but probably counting chickens before the eggs were even laid in the first place. At any rate, as the valuation burned off, we warmed up. Again, we steadily said a very cautious, prudent dollar cost average approach would be best all through 2023, including when all of the accelerated AI hype started to heat up with Nvidia. We're going to explain why we continued to say why Snowflake was still a prudent DCA stock at best, even when the AI market started to heat up last year. But as 2023 progressed and it became increasingly clear that this new generative AI infrastructure being installed wasn't going to be just a short-lived hype cycle, it started to become apparent to us that at some point over the course of the next 2 years, enterprise software companies like Snowflake would eventually get a trickle down effect from the AI market. So here we are in March 2024. The stock still is not cheap, but one last sell-off finally has pushed us to the edge, to the brink.
This valuation change and our view of Snowflake in general came as CEO Frank Slootman is retiring and the revenue growth rate dipping below 30%. The retirement itself is no real shocks. In 2023, Slootman was awarded a pretty sizable stock payday worth hundreds of millions of dollars, and in addition to a few $billion worth following the IPO a few years back. So he's riding off into the sunset, into retirement with literally bags of money. So the stock awards were buried in the SEC filings all along, but it's very complicated and a convoluted process and disclosure at best. Now, new CEO, Mr. Ramaswamy, is at the helm, and we'll talk more about this here in a few moments.
Yeah, that's right, Casey. It was a double whammy for the stock having these two things happen at the same time. The announcement of Slootman's retirement, or I guess some are billing this as semi-retirement because he will remain chairman of the board. For all intents and purposes, that's not a day-to-day job. He's retiring. He's 65. Yeah. So now that the stock is not trading for nearly 200 times sales, it's more now less than 20 times trailing 12-month sales, less than 70 times trailing 12-month free cash flow. It's ironic to us that it took this double event on the last earnings to get the stock down to a more reasonable valuation again. We're now more comfortable to approach this and actually start nibbling. Okay, so let's zoom back out and take this thing through our process, our framework, because a lot of investors have suddenly lost interest in cloud stocks. And again, this is ironic because this is still very much a growth industry. As we've highlighted before, Gartner predicts that end user spending on the cloud is going to be up 20% this year. We're fast approaching a $1 trillion cloud market here within the next few years, and still ample room for growth because the global IT market overall is a $5 trillion industry. Massive amounts of growth here for Snowflake, both in cloud and on premises via a private data center or maybe an on-prem data center based computing system, private networks and whatnot. So another thing that has kind of hit investors' radar here in the last year, which we think we helped bring to light to the investor community anyway, is competition being an actual real risk for Snowflake versus in the early days, it was kind of pitched that this thing was a totally unique asset. No one was going to touch Snowflake's software stack. But let's talk about this. So in very high level terms, we won't repeat all of what we've said before, but that Snowflake has a data warehouse and a data lake service. Data warehousing is when data has been cleaned, processed, and it's ready to be utilized. And then a data lake is raw, unprocessed data in very simple, high level terms. And then they've been steadily building new services on top of that. So not just data storage, but a lot of analytical and compute services, especially built within that data warehouse and data lake so that customers can make better use of its data without ever having to transfer it. These days, all sorts of cloud software companies offer some sort of data storage solution so that customers can actually make use of their information within that respective software service. But the big competitor that has suddenly crashed the party is Databricks. Databricks in the last year, still a private company, but over the last 12 months, lots of speculation that an IPO is coming for this company. These two services, Snowflake versus Databricks, have a lot of overlap, though they have gotten their start in two different respective corners of the software industry, you could say. Again, we're not going to delve into this, but as is typically the case with software businesses like this, there always eventually are two leaders that tend to emerge. And though they're not exactly the same business model and services list, as they grow and expand, they start to encroach on each other's turf. That's definitely what's going on here. So one advantage that Databricks maybe could have, as cited by some investors, is that Databricks is led by a co-founder. It has a co-founder, CEO, Ali Ghodsi. To a certain extent, Snowflake does not have that visionary founder or CEO, kind of like a Mark Benioff of Salesforce. But getting Ramaswamy in via that Neeva acquisition that you mentioned, Casey, maybe gets Snowflake the closest thing to a visionary founder as it could have at this particular point in its history.
Now, Snowflake will definitely need to keep building and acquiring some ancillary services. And we think that Snowflake knew this all along. And that's why they had such a massive IPO back in 2020. Cash and short term investments, which is 3.85 billion, still in fantastic shape with no debt. So, what it may lack in a visionary founder, it more than makes up for in a highly scalable platform that can add on plenty of bolt on acquisitions. Let's talk a little bit more about that new CEO and how his role came about. As you mentioned, with the acquisition of Neva, which provided data search functions using Gen AI. Mr. Ramaswamy from Neva is familiar with the hardware and software business models. He's worked at Google, which is arguably the most data center computing rich organization. Bell Labs, which is part of Nokia, but has had a long history of computing hardware innovation breakthroughs and other engineering roles. Mr. Ramaswamy has had past successes scaling mid-sized businesses, specifically as part of Google Ads business when it was doing just 1.5 billion a year in sales. Snowflake's product revenue just came off a 38% expansion rate last year, or fiscal 2024, which ended in January. This included 33% growth in Q4. But Snowflake management expects it will slow to just a 22% rate this year, or fiscal 2025. Management will no doubt be making this growth rate a top priority by some means, either organic and hopefully, in our opinion, via some further transformative acquisitions.
So, yeah, we think there's ample opportunity here for Snowflake to beat the cloud market growth rate. Again, Gartner said about 20% growth expected this year by their estimates. And so Snowflake expecting just 22% revenue growth this year, definitely a disappointment. That's barely outperformance for a company that's really at this point not all that large, still less than 3 billion in annual sales. But there is some hope here. Casey, this slide here, RPO, remaining performance obligations, basically commitments from customers to spend in Q4 of the last fiscal year, reaccelerated to 41% year over year growth. Over the course of the next 2 years, which is what most RPO is, it's commitment to spend some amount of money over the course of the next 2 years. In the next 12 months is the light blue, and then further out than that is the dark blue bar. We do think Snowflake has opportunity to increase its growth rate again and maybe outperform that overall cloud market growth of 20%. And again, just to be perfectly clear here, this is not that large of a software business in the grand scheme of things. At less than 3 billion in annual revenue, we think anything less than them figuring out how to reaccelerate and reignite growth would be a bit of a disappointment.
You may be wondering when we're going to introduce the term AI into this discussion about Snowflake. When will generative AI growth start to take hold for this business? As we have mentioned before, accelerated compute infrastructure will take time to trickle down to Snowflake. Much of NVIDIA's hardware has been going to the data center giants, think Google, Microsoft, Meta, and Amazon, for their own internal AI usage. The enterprise market, and especially AI inference, is only just now getting installed. After the new computing hardware is installed, it takes time for customers to learn how to use it, train AI models, and then deploy it, let alone roll out new products to customers and start getting revenue from that. We still think that next year, calendar year 2025 for Snowflake, is when we'll really start seeing accelerated compute revenues start to have an impact on the cloud software industry.
So we're illustrating this here by repurposing our cybersecurity industry flowchart. If you want a discussion of what that is, link to that in the video below. But this flow of infrastructure and data moving through that infrastructure works in much the same way for all sorts of software industries. Cybersecurity, now generative AI, take your pick. So where we're at and where we've been for the last year plus is NVIDIA's accelerated compute systems have been getting installed mainly into first the big public cloud providers, and now increasingly enterprises, maybe a private data center, on-prem physical location, into smaller regional data centers located closer to users. We're still really not yet at that point where the most useful generative AI software services are trickling down to actual devices and users. That's what we're illustrating here. Much of the work is still on the infrastructure install side, and service and product-based company like Snowflake still hasn't really rolled these new services out to those mobile devices and to their customers, their enterprise users yet.
While many investors are ditching Snowflake, we think that there may be an opportunity to scoop up shares at a relative value before the broader market figures out how all of this tech ecosystem works. We have the same slide we had earlier, the remaining performance obligations that Snowflake has, showing that it is heating up. And that could be indicating that Snowflake data consumption could be about to tick higher in the next couple of years.
Yeah. And of course, it remains to be seen if that's driven by generative AI or not. Maybe it'll just be a general solidifying of the global economy. We'll see. But we see some possible positive signs here. Okay, let's move on to valuation. And just to be clear, we'll reiterate again, we don't think Snowflake is a cheap stock. We personally have now warmed up to the idea of finally nibbling ourselves on this one. We're probably going to make a starter position in this within the next couple of weeks, but we are remaining overall cautious as we do this. Let us show you why here. We just did a very, very simple reverse discounted cash flow model on this. And this is based on what appears will be the share price on Monday morning, March 18th, 2024, roughly $158 per share, which works out to about a $48 billion enterprise value. So what is the market assuming? If that is indeed the fair value of Snowflake, well, we used $2.29 free cash flow per share from the last year. And to get us to a fair value of, just call it $160 to $170 per share, we plugged in an average free cash flow per share growth rate of 20% for the next 3 years, and then a terminal free cash flow per share growth rate of 8% thereafter, which we think is pretty fair for a mature software business. We used a discount rate of 10%, and that's what gets us to roughly $160 per share fair value. We think that's a fairly conservative bar for Snowflake to clear over the course of the next 3 years or so. Our takeaway here from this, though, is we're assuming a few things. The company eventually gets rid of some of those highly dilutive events. Casey already mentioned one of those earlier. Mr. Slootman had that very large payday last year. You can see the very large stock compensation in the last year continuing to ramp up. So we would assume that over time, the company gets this metric, especially under control, stock-based compensation. However, free cash flow per share growth does account for dilutive events like this. That's why we are always using per share metrics when we're looking at free cash flow. At any rate, we would expect that light blue bar to moderate over time. And as they do so, we're also assuming that GAAP profitability, GAAP net income, of course, flips to profitability versus the net loss Snowflake reports now, and starts to converge with free cash flow over the next 3 years or so. And along the way, we would expect to see free cash flow margins in particular. But once the company does flip to GAAP profitability, we would expect to see profit margins tick higher a little bit along the way. Growth of the cloud industry certainly going to help, but we hope that Snowflake starts to put its really hefty cash and short-term investment balance to good use. They have almost $4 billion on hand. They're free cash flow positive. We see a clear opportunity for the company to re-accelerate their growth in both the cloud and the more traditional IT industry, because their software very much has use in both applications, and especially in this new generative AI era, where a lot of companies are actually interested in maybe keeping their data on-prem in some form or fashion rather than sharing it in the public cloud.
All that said, that's why we're ready to start nibbling on Snowflake over the next couple weeks. Stay tuned for more discussion on those other 4 companies that we talked about at the beginning: Broadcom, Oracle, PureStorage, and DigitalOcean, all coming up in the coming weeks on Chipstock Investor. Again, make sure you hit that subscribe button if you have not done so already. We appreciate it very much. And if you're interested in more deep discussions, you can join our membership here on YouTube or over on Ko-fi. That will get you access to our Discord channel, as well as some fun badges to use in the comments. We'll see you all again soon at Chipstock Investor.